Thanks. All right, so let's get going. Lots going on in commercial real estate, and this is my 37th year. I'm only 28, but this is my 37th year, and going through the data and what's going on in Houston right now, it's about as muddy as I've seen it. I tried to get a slide, and I got dick made on it, but it was a British firm that said they were going to be putting up a BS filter, except they spelled it out, as a service to eliminate all the broker BS that we spread. My staff, which has much more class than I have, wouldn't let me put it up there. But I thought it'd be a good way to enter this. And but I do think it's important that when we stand up here, we're not up here to spin the market one way or the other. We're trying to give you guys our best sense of what's going on. And it's a little sloppy this year. So let's go ahead and dive in. Lots of good news. And I don't think you can be in Houston and not know the good news, but we did another one of our fun little videos. So lots of good news. Houston's a happening place. You know, I saw NASA pop up there, and now we have Space Force coming. And they even use the Federation logo, which you gotta love that if you're a Trek fan. But we know that contracts are already being let down in Clear Lake to work on the Space Force space stations and the new stuff coming. So hopefully we'll see a space boom that'll come out of that and benefit this area. But let's talk about what's going on. So we always like to start with what we say last year and then what happened. Last year we said, the IMF said we'd have growth of 3.5% globally. We ended up at 2.9, now they're saying 3.3. Barring any black swan events, maybe like a coronavirus in China, that you saw the market did yesterday. China is now blocking people off. They're building hospitals, which, think about that. We need some hospitals. Let's build a hospital this month and get people treated. But that virus has the potential of slowing down global growth because it could slow the Chinese down just as we're coming out of the first phase of the trade war. So, but growth, decent growth. U.S. The projection last year was that we would have 2.5. We ended up at 2.3. But a big, and the projection is 1.9. A big part of the drop is Boeing. I don't know how many of you know this, but Boeing represents 50 basis points of our GDP, one company. They're the largest exporter in the United States in terms of value. And when they stopped shipping planes, it cut our GDP, one company. My guess is they'll get their act together and get going again, but I did not know that when I first started paying attention to this, but we're looking at about 2% growth. Anybody know what the average growth for the United States is for the last 15 years? 2.1. So, you know, ups and downs, average it all out. 2 is good, steady growth. Unemployment projection, right now for the U.S., we're about 3.3, 3.4. The workforce participation rate's gone up a little bit. That's good news. Basically, it's going to stay fairly flat is the projection. The reason for that is it's very difficult to get below 3.5%. I remember when they used to say full employment was 5% unemployment because people were moving between jobs, and now they're saying 3.5%. The big change is the Fed has now accepted that we can operate at 3.5% without pushing inflation. And there was a time when the Fed would have fought 3.5% unemployment because they'd be afraid of wage inflation. They started to fight it a little bit last year, and then they gave up and gave in. So that's good news. Inflation, relatively tame at 2.2. Again, the Fed would like to see a little higher than that, and the risk we run is that we end up like Europe, where we could have deflationary and negative interest rates. So good news is we're running at a pretty good pace. Treasuries, last year we said that we'd get to 3%. We ended up at 1.9, and for a while we were down around 1.6. Nobody liked that. We had an inverted yield curve for a short period of time, which generally most of the recessions have been the predecessor to that has been inverted yield curve, where the short-term rates are above the longer-term rates. We don't see that now, although it's fairly flat. So things are good. The country looks good. Houston depends on the rest of the country and the rest of the world to grow for no other reason than the consumption of what we produce, both energy and plastic. 17% of our GDP, according to Patrick Jankowski, is in exports going out of the port. And the port represents another 3% on imports to our GDP. So we need the rest of the world buying what we're making. What's driving it? The consumer's happy. So we hit 136 today. Anything over 100 is good news. 136 is great news. Stock market's happy because consumers are happy. Consumers are happy because they have jobs. And wages are going up at the bottom end of the wage brackets more than they are in managerial. So hourly people and people at the bottom are doing better. They feel more secure about their jobs. If they lose their job, there's another job out there for them. This good and bad news, we're going to touch on that a little bit more, but this drives most of our GDP. I think it's 75% of our GDP is the consumer. And you can see that steady rise from the crash until today. Small businesses, the big drivers of new business generation and jobs, again, still happy. They were at 104 in November, it dropped to 102. But there's a general consensus that the economy is going to continue to get better and that their sales are going to go higher. In some of the other areas, they're not quite as sure. The margins are getting squeezed. If you're a restaurateur in Houston or anywhere else, let me just pick on that industry for a second. A great operator in the restaurant business makes high single-digit net profit. And that's somebody that actually knows how to run a restaurant, not just cook food. Real estate costs have gone up, operating expenses costs have gone up, cost of ingredients have gone up because people want locally grown, organic, and that's more expensive than the heavily chemical, genetically engineered, whatever else we were eating before. I'm not sure we all survived it. And then their wages of their employees have gone up, so they're getting squeezed in every direction. And you're going to see, and we have seen, a lot of restaurant closures lately. And it's because things are really good, but that does cut into, if you can't raise your prices too much, it cuts into your profitability. So, again, mixed. This is the one, normally we go through rig counts and projections on oil, but since we've never ever gotten that right, we decided not to do that this year. But it's impossible to be in Houston and not know that energy is under all kinds of pressure. I'm going to quote Jankowski again. He said we should not plan on the energy sector helping us with our commercial real estate vacancy for the next 10 years. And spend a hell of a lot of time talking about the 1990s and how we grew 500,000 jobs during the 90s, but the energy sector only contributed, I think it was 5,000 or 6,000 of those jobs. He feels like we're entering into that pattern again. McDermott is in Chapter 11 as the offshore drilling continues to be very weak. There's ripples through all the engineering firms that do these long-term projects. So definite issues. Chevron took a $10 billion impairment write-down for their gas in the ground values, mostly natural gas because the pricing is not there. Shell took $2 billion and then wrote off another $1 billion for wells that they were capping and shutting down. So these are big. We haven't heard from Exxon or BP on what their write-downs are going to be, but energy companies, generally speaking, they're going to take their lumps when it's bad and they're getting ready for the next round, but it's not a sweet spot. And then I actually learned this last week on Friday morning, so you're getting it now, but I was at a similar event in Kansas City, and Casey Conway, who's a very frequent speaker here, started talking about ESG scores. And this is a new score, and it's your environmental, your social, and your governance score. And if you have a high-risk ESG, Wall Street is starting to say, we're not going to give you money, and we're going to drop you from our investment portfolio. So the energy companies, you can imagine, are not best friends with the green crowd, despite the fact that they're probably the largest investors in green energy, but their scores aren't very good. So there's a new S&P index fund you can invest in, the S&P ESG, and 23% of the companies that are in the normal S&P 500 have been excluded from that because their ESG score was too low. Goldman Sachs just said, if your board of directors is all straight white men, they won't do your IPO. So there's a lot of pressure, and what this means is if you've got low scores, and if you're in the energy business, you're probably going to have a low score no matter what you do. Capital is going to dry up. The question is in what amount, which means it's more expensive. So this was interesting. These are the 15 oil companies or energy companies that I found just going through the excluded list that are on the S&P 500. Now Exxon's not on here because they're on the Dow. But here's 15. You'll recognize several of them have a big presence here. Now 2 of them just merged, Oxy and Anadarko. Newfield is operating under they've been acquired, but a lot of big Permian players here, which has a lot to do with what we're doing. So that's interesting. Here's Exxon, and here's the score. Exxon has a 37, which puts them in the 76th percentile. Most of these people want you to be above the 75th. Exxon's bad score is 18.6 on the environmental. Apple is 0.6, if you want a comparison. Now, Exxon actually scores better on their social risk and on their governance than Apple does. But their overall score is a 37, which is high. Apple's is a 24, which is moderate. Nobody's going to run away from Apple. So this is my point, that I think the energy companies have got a special problem because the business they're in, the green lobby doesn't like. There was an article, an opinion piece written by the mayor of the North Point borough, and the topic was, or his title was, Goldman Sachs tells Native Alaskans to drop dead, because Goldman Sachs has said they will no longer invest any money in drilling in the North Slope. And his point as a native Alaskan is that it was oil that took them out of poverty and got them to, they hunt fewer whales and they have electricity in schools and hospitals, and now Goldman Sachs is saying they're cutting off any money for drilling up there in order to placate the green lobby. So this is I'm sitting in Kansas City listening to this and thinking the implications in Houston, and they're not small. So again, Mr. Sally Sunshine up here, I told you it's mixed, it's all we can do. All right, so let's go the other way. I mean, don't look for energy to be, they're not going to, most of it's happened. There's going to be some more M&A and some more layoffs, but we're not going to see the kind of crash we saw in 2014, 2015. So it's going to be somewhat neutral. So other than that, the play was fine. Population, we're over 7 million and growing rapidly. We're averaging about 110,000 new people moving into town every year. About 45, 47%, if I remember my math, of the people that live in Houston work in Houston, which is actually fairly high if you think about it. I mean, if you've got a family of 4 and you got 2 little kids, that's part of your population. Both parents are working, the kids, you know, maybe you haven't put them to work yet. I've got mine making tennis shoes down on the south side. But the reality is we've got a high working population here, and we're running at 3.5% unemployment. I talked about the good and bad news there. The office market, I think, is everybody's going to have issues hiring people. If 100,000 people move in every year, and half of them enter the workforce, we've got about 50,000 new workers a year. There's 150,000 unemployed people in Houston right now, give or take. So about a third more. The question isn't though whether they're unemployed, it's whether they're employable. The rest of the country was faltering and they didn't have jobs because they would come here to get one. But if they're employed at home, we may not see as much of the moving going on. So a little bit of concern there. Our wages are just a little above the average. For a big city, that's great. Education, we're a little smarter than, or more educated, whether we're smarter or not is a different discussion. But we have 1% more than the national average, and our top 3 industries for hiring, restaurants, which we just talked about, education and healthcare and government, and government, a lot of the government jobs are government, it's the school boards, it's school people. So those are the top 3 industries. Interestingly enough, energy wasn't one of them. We added about 85,000 jobs last year, as you saw on the video. They do expect that number to be revised down when they get the final numbers in, maybe closer to 70-something thousand. The projection for next year is 42,000 net jobs, which is, we average about 60 to 80, so that's a little below average. Again, I'm gonna put my Sally Sunshine hat on one more time. We're losing jobs in the energy sector, and all of the jobs in the up and midstream energy sector, the average wage is 110,000 or up. The average wage for every other industry, non-energy, in Houston is 60,000. So we're trading $120,000 jobs for $60,000 jobs. That's going to cut into the high end in the market, high-end housing, high-end restaurants, high-end automobiles, because the people that are making $150,000, $200,000 a year more disposable income tend to spend a little bit more than somebody making 50. So while we have net positive job growth, the buying power of the population is being negatively impacted. So again, not negative. It's not what we saw back in 15 and 16, but it certainly is not the robust thing we've been seeing in the last couple of years. So this one says IT, information technology and communications dropped. Not exactly sure where that came from. We expect this to get revised downward based on everything we're hearing from the economic development agencies and frankly the staffing companies. Had another point there that's going. So old age is setting in. Sorry about that. All right, so let's talk about what's going on in real estate because that's sort of what we do. Single family is doing great. We're pretty much on par in terms of changes in value with the rest of the country, in that we're running about a 2.3 average increase in values, and the median price went up 3.2. Nationally, I just heard this number this morning, single family values on average went up a little over 3% when you factor in the rest of the country. We deliver product easier and faster here, new homes and new lots, et cetera, than most of the rest of the country. So our supply and demand doesn't get out of whack very often. When the rest of the country had that big housing run up that ended in the 2008 crash, Houston had about a 3% increase average over the previous 15 years in single family, whereas some markets like Las Vegas, LA, Tampa, where it takes 2 or 3 years to get a project through approvals, they were getting 10, 15% increases when we were chugging along. This is nice, healthy growth, and we had a record number of sales last year, so that's good news. On the multifamily side, in 2016, we got up here and told you how overbuilt it was in most markets and how tough everything was. God sent Harvey, which took a lot of us out of our houses and put us into temporary renting. That allowed the multifamily world to enjoy a year of unusual occupancy, but everybody figured out the overbuild in 16. 17, there wasn't a lot going on, and we had an opportunity to correct a little bit of an overbuild. Occupancy now is 93.6. Anything over 93 is pretty healthy in the multifamily market. And my same caveat as always, this is an average for all of Houston. We have, I think, 125 cities, and we're bigger than New Jersey, so you got to go market by market in terms of the health of anything I bring up today. But 93.6 is excellent, and the under construction numbers is down a little bit. Deliveries are going to be up, meaning coming online this year from what we saw last year. And that's mainly because in 2018, we only delivered 5,300 units because we sat on the brakes. This year we delivered about 16,000-ish. I've seen different numbers, but we absorb around 15,000 a year, so that's about keeping up with it. There's 22,000 under construction that will deliver in both 20 and 21. So that market's actually in pretty good shape. The office market is as confusing as I've ever seen. I've had discussions with several of you in your driveway about why you're building another office building, but I since have figured it out, and I hate to say it, but those of you that told me there's a flight to quality, you were right. So the light green is 12 to 17% vacancy. The dark green is the healthier markets. They've got fewer Class A office buildings, so they tend to do a little bit better. The red is over 20% vacancy for Class A, but note the note. If it was built after 2005, you're at 11% vacancy. So, unfortunately, if you are an office developer and you say, well, everything we've built's full, and it's leasing up fast, there is in fact a flight to quality. People are looking to, they're okay with paying more rent to be in one of these new buildings. And what's really happened is office developers are building places to work, not spaces to work in. So you'll hear that as a theme. The mixed use, the park across the street, it's more about place, it's about energizing the lobby and making it a more interesting place to be. I heard the other day that out at City Center where Marathon Oil is going, they were attracted to walkable hotels, walkable restaurants, live, work, play. There's apartments there. They also needed the co-working that existed on place for their flex. You hear a lot about co-working and WeWork because it was such a disaster in the stock market. But co-working is here to stay, especially with new technology. So it's a weird market. We're delivering buildings and they're filling up at the same time the market has the highest vacancy in the United States. So where does it go from here? If you own a B office building, you're gonna feel those tenants moving out. And the older A's, Brookfield, when they bought Houston Center, they're investing tens of millions of dollars into making those like new buildings in order to keep up and stay permanent. So it's an odd market. I think rents stay pretty flat despite all of this, especially if you're outside of the few new towers that we've delivered. I do hope everybody slows down on that and we take a breath. We've got roughly a 12-year supply of office space-ish. By the way, when I moved here, everybody told me a building hadn't been built in the Galleria market since '86, and then they started building them again in 2005, so that was a 20-year supply. So if you do the math, it's not real pretty. We need 50 to 60,000 jobs in order to pull 5% out and get down to about 15%. We don't have 60,000 unemployed office workers in the market. So if everybody decided to hire tomorrow, we don't even have the employees that can take the seats. So this market's going to be a little ugly for a while, depending on where you are. If you're in Sugarland or the Woodlands, you're doing great because they've controlled the supply side, and we didn't build as many empty energy buildings for the 2014 run. So that's the office market. I hope you all drank heavily before this. So the industrial market. The industrial market is getting a little overbuilt. It's still the sweetheart. Everybody wants to own industrial in Houston. Everybody wants to own industrial everywhere. That's the e-commerce push as much as anything else. So e-commerce, online retailing, whatever you want to call it, is growing at about 17% per year, which means it'll double in roughly 4 years if it's compounding, which means double the deliveries that have to occur. So distribution space, both market, where you might be delivering to all of Texas or the Southeast United States, as well as citywide, and then we've been calling it last mile, they're now calling it last touch, and that's the distribution centers that can get you whatever it is you ordered within a few hours. So Amazon's opened 100 DCs, the distribution centers around the country. They've got plans for, I think, another 30 to 40 around the U.S. I know that they're working on at least 2 right now in Houston, and a couple of more have been completed. If you look at the big industrial deals that have been done lately, some of the headline was Costco that went out west with a nice big project. Home Depot just did a new DC. You know, a lot of these are retail projects that are going on, but again, if you look below the line, this is the opposite of what we saw in the office. The vacancy rate for the new stuff built after 2005 is 13%. So some of that's, we're delivering a hell of a lot of spec, and we're absorbing about 8 million feet per year. The projection is that's going to increase, not decrease, because of everything going on with e-commerce. And you'll hear more about that when Jay comes up with what we'll be able to do with this 5G, but that's not going to slow down. I do think we need to tap the brakes a little bit on the spec, new industrial coming online. We had overbuilt the port a few years ago, and now it's tight again. Yellow is 6 to 7%. That's not a horrible market, but when you start getting to about 13% in all the new stuff, it's probably time to slow down. Lots of build-to-suits going on. So here, Ross stores, again, 1.2 million square feet for retail distribution. Ton of that going on, and then Medline's doing a $1.3 million square foot distribution center. So if we absorb 8 million square feet this year, we're going to deliver about 18 million this year and next. That's about a 2.5 year supply that we're bringing online at the rate we've been going. Rearview mirrors are scary because that number can change to the positive very quickly. Retail is the messy one because of e-commerce. 9,300 stores closed last year, 25,000 in the last 3 years, and 1,200 have been announced so far this year. A lot of them are the big boxes. Obviously the department stores, the number I saw was it's roughly 100 million square feet of retail space where the stores are closing. Now, lots of creative reuses. HEB is turning a dark grocery at Memorial and Dairy Ashford into a distribution center, which is fine for them. It's not great for the rest of the center, but they're doing that last mile delivery out of there. So lots going on here. The big boxes are the ones that are the most in trouble because a lot of what they sell you can get online. So there are a lot of changes there. The malls are slowly dying. The anchors are dying. Sears, which at one time was the greatest retailer of all time, and by the way, it was Amazon before it was cool. They had a catalog you could order from. You know, they're all but gone at this point. But we're seeing some really cool creative reuses. A couple of department stores, they've cut them in half, created an atrium down the middle, dropped windows in, created a little park in the middle of what used to be the 2-story department store, and call it a high-tech office building. So there's a lot of that stuff going on. On the industrial, I'm going to go back, I saw this the other day, I thought it was very cool. The older buildings that have the lower ceilings, everybody's saying, what are we going to do with them? Well, Bezos invested in a company called Plenty, P-L-E-N-T-Y, and it's a vertical farm in a warehouse. And they grow organic, locally grown vegetables for the restaurants in town. But most of you, I think, probably know Amazon owns Whole Foods. So Bezos is now growing lettuce, kale, whatever. I'm not a big, you can't grow meat, so I don't know. But they're growing the green stuff and you put all the sauce on to make it taste good. Anyway, it is organic, and some of them they're raising fish, and they use the fish water to fertilize the vegetables. They use 5% of the water that a traditional farm uses, and 1% of the real estate. And they grow them sideways. They can adjust the lights to make the lettuce leaves a little thicker if they tweak it at the right point in the grow cycle. And I saw a video where they had all these restaurateurs, the organic, the granola crowd, saying this stuff tastes better than what we were getting from the traditional farmer. So I think it's typical of us. You know, when in doubt, innovate. And if you can grow better food organically with 5% of the water, that helps us with our water issues, and 1% of the real estate, and it's backfilling industrial buildings. So it's just staggering to me where that's coming from. But Whole Foods will literally, when Plenty first opens, they will commit to buying 100% of what Plenty grows just to stock their own shelves. So hopefully you found that as interesting as I did. But retail, there's only 2.2 million square feet under construction right now at 256 million, so 1%. It's operating, and that's 68% pre-lease. The big projects are 188,000 feet and 105,000. 5 years ago, those numbers would have started with a 3 to a 5. The big power centers are basically on life support at this point. There's not a lot of things going on. So, well, a couple other quick issues. The banks are doing well, but they've been heavily investing in commercial real estate loans. They hold 51% of all the debt. That debt's in pretty good shape, but what I heard last week from KC, who used to advise Ben Bernanke, is that some banks are going to be out over their skis and have to cut back on their commercial lending just because their portfolios are tapped out. But loan delinquencies are at an all-time low. So the loans are in good shape. The biggest delinquency problems in retail for all the reasons that I just covered. And so where are we in the cycle? Full caveat to everybody here. As I said last year, we make this up. So apartments, rents are going back up. They're growing at about 3%, which is a pro forma normal in a good, healthy market. So there's no question that multifamily is back on the happy side. Retail has just sort of been hanging out right here for a while because they don't build it unless they're 60 or 70% pre-leased. And they just haven't gotten any oversupply. We think industrial has now pushed it a little bit over to the other side. We're going to see some downward pressure on rents, kind of covered that. And we couldn't decide whether to put office over here or over here. Either way, you know, I mean, unless you're one of these geniuses that's building the new building in the city center. The office market's got a lot of issues as a whole. So anyway, that's it. So hopefully that was enlightening and not too frightening. We're positive. We're actually thinking this year's going to be about like last year.